According to the standard, Mfrs 8 is an operating segment which is a component of an entity that meets three key criteria. First, it must engage in business activities from which it either earns revenue or incurs expenses. Second, its operating result must be regularly reviewed by the chief operating decision maker for the purpose of allocating resources and assessing performance. Lastly, discrete financial information must be available for this component. This means the segment's financial data can be separately identified and tracked. Chief operating decision maker is not always a specific person with a set title. It's more of a function or role within a company. This role involves two main things. First, allocating resources to different parts of the business. And second, assessing the performance of those parts, which we call operating segment. The person or group acting as chief operating decision maker can vary depending on the company. It could be the CEO, a senior management team, or even the board of directors. What is important is not their job title, but what they do. If they are the ones making strategic decisions about how the business is divided and managed, then they are the chief operating decision maker. So, here is the example of chief operating decision maker of Celcom DG. First, we have Datuk Idham Nawawi, and he is the chief executive officer of Celcom DG. He responsible for leading the overall direction of the company. And the second one is we have Eric Etzel Sigurd Marel, and he is the chief strategy officer, which he planned the long-term direction and competitive positioning of a company.
Next, we will proceed to types of segmental reports. There are two types of segmental reports, which is business segment reporting and geographical segment reporting. For business segment reporting, it is a component of an entity that engages in providing an individual product and service or a group of related products or services. It is a business activities from which they earn revenues and incur expenses. For geographical segment reporting, components of an entity that engages in providing an individual product and service within a particular economic environment. It is based on the location of operations or customers. This is a business segment report snippet from Celcom DG Berhad's financial report. So as we can see here, the business segment is divided to postpaid, prepaid, home and fiber, and the last one is enterprise solutions. So this is from the financial year 2024. This financial report is for the year 2024. So if we look at the business segment, for postpaid, we have an increase 2.6%. For prepaid, we have a decrease 3.4%. And home and fiber, we have an increase 3.8%. So the revenue for the year 2024, for the postpaid, we have RM 4,181 million. For prepaid, we have RM 4,460 million. Home and fiber, we have an increase 34.4%. And enterprise solutions, we have an improvement of 5.2%. Next, we will move on to geographical segment report snippet from Celcom DG's financial report. This financial report is from the financial year 2023. In this financial report, the region in Malaysia with the revenue are at 12,680. The entire revenue from Celcom Digis is generated from Malaysian operations. Since Celcom Digis is operating only in Malaysia, therefore, all revenue is attributed to this geographical segment.
There are two key benefits of segmental reporting for financial statement users, which is enhanced transparency and informed decision making and alignment with management internal reporting. Let's discuss two key benefits of segmental reporting under Mfrs 8. The first benefits are enhanced transparency and performance evaluation. Segmental reporting provides a clearer view of how different parts of the business are performing. By breaking down revenue, profit and other financial data by business unit or region, stakeholders can identify profitable and underperforming segments. This allows users to see which segments are driving the company's success and which may need improvement or restructuring. The second one, stakeholders can access risk and return profiles. Different segments may have different risk levels and returns potentials. Investors can evaluate where the business is most exposed or where the best opportunities lie. Thirdly, stakeholders can make informed investment decisions, which detailed segments data users can make more accurate forecasts and better decisions about investing in or lending to the company. Internal reporting. Mfrs 8 follows the management approach, which means segment reporting is based on the internal reports used by the company's chief operating decision maker. This has several advantages, which is consistency between internal and external reporting. Since the same data used by the management is shared with investors, there is greater trust and clarity in the financial reports. Secondly, improve decision making. Users gain insight into how management views and operate the business, giving them a better understanding of strategic priorities and performance drivers. Thirdly, enhance comparability. It becomes easier to compare companies in the same industry, as the internal-based reporting reflects how each business is actually managed. In financial year 2023, Celcom-Digi's total revenue grew steadily by 1.4% to RM12.68 billion, showing solid business performance. Service revenue also saw a slight increase of 0.4%, reaching RM10.86 billion, reflecting stable core earnings. Earnings before interest, tax, depreciation and amortization rise by 3.3% to RM6.116 billion, indicating improved operational efficiency. However, profit after tax dropped by 20.2% to RM1.57 billion, mainly due to higher costs and expenses. Lastly, capital expenditure increased by 6.1% to RM1.76 billion, showing the company's continued investment in infrastructure and future growth. Mfrs 134, which is Interim Financial Reporting, is a Malaysian financial report standard. This standard provides guidelines for preparing and presenting interim financial reports, which typically cover periods shorter than a full financial year, such as quarterly or half-yearly reports. The main goal of Mfrs 134 is to standardize interim reporting by setting minimum content requirements. It ensures that the financial information shared during the year is timely, relevant and reliable, especially for stakeholders like inventors, analysts and regulators who need up-to-date insight to make decisions. This standard applies to entities that are required to issue quarterly or half-yearly reports, whether by regulation or voluntarily. It promotes consistency in financial reporting across reporting periods and support compliance with legal and regulatory requirements. Under Mfrs 134, company must apply the same accounting policies as they do in their annual reports. The figures reported are based on a year-to-date basis, which means they accumulate from the beginning of the financial year up to the reporting date. Because interim periods involve less data, they typically agree alliance on estimates to ensure timely reporting.
One of the two significant events during the financial year is the purchase of property, plant and equipment. Firstly, this transaction results in an increase in non-current assets. The acquisition of PPE adds to the company total asset base, which is reflected on the financial position statement. Secondly, there's an impact on depreciation. Once these assets are acquired, they begin to depreciate over their useful life. Depreciation systematically reduces the carrying value of the asset each year and is recorded as an expense in the financial statement. Now let's look at the second significant event, obtaining a loan. When a company obtains a loan, this results in an increase in liabilities. The company now has a legal obligation to repay the borrowed amount. However, at the same time, the proceeds from the loan typically increase the company asset, such as cash or bank balance. This change in the financial position must be disclosed under Mfrs 134, which governs interim financial reporting. The goal is to ensure that stakeholders are provided with relevant and timely about significant changes in the company financial health. Let's take a look at the interim reporting periods for Celcom-Digi Berhad for the financial year 2024. This table outlines the financial statements that are being reported, along with the relevant reporting periods for both the current and comparative year. Starting with the statement of financial position, the current interim reporting date is as at 31st December 2024, and the comparative figure is from 31st December 2023. This allows for a direct comparison of the year company's financial standing at year ends across two consecutive years. For the other three financial statements, statement of changes in equity, statement of comprehensive income, and statement of cash flow, the reporting period is defined as for the year ended 31st December 2024, with the comparative period being for the year ended 31st December 2023. This format reflects the company performance and changes over the entire financial year. These interim reports are essential for tracking financial progress, informing stakeholders, and ensuring regulatory compliance throughout the fiscal year. As shown in the slide, the financial statement presented is the unaudited consolidated statement of comprehensive income for the period ended 30 September 2024.